Hi everyone. Here is an explanation of the answer with regard to the cash flow statement that you did for practice. Hopefully you've already completed and given it your best shot, but this will give you an idea of where you may have done what you've done correctly and what you may need to fix going forward as far as cash flow. So I have here the income statement and two balance sheets. That's what you need to work with. So generally I set it up in an Excel spreadsheet. First thing we want to calculate is how much cash increased. That's 436. So that's our goal, to explain that. We take our net income, all right, and I did this in order that they show up in here to make the math easy, but you can look at these in any order. There was a decrease in inventory. Check that off. We did that. 60. Deferred taxes. Check that off. And other current assets. Check that off. So deferred taxes went down, so our cash went up, and the other current went up, so our cash went down. Here is then gains and losses. You see on the income statement we had a loss on the sale and a gain on the sale. So I did those two separately there, and then depreciation comes from the income statement. Depreciation and amortization is actually the full explanation. So there's that. Then we start with the current liabilities, accounts payable, accrued liabilities, interest payable, income taxes payable. Now we get to current portion, and remember our assumption is that current assets and current liabilities are operating assets and liabilities. Well, this is one which is a current, but because it's current portion of long-term debt, it really is not an operating liability. It should be considered under financing. So we're not going to put it here under operating. And we have this note here under a long-term liability that deferred income taxes belongs in operations. So we are going to put the difference here, the 29 that went up, so we're just going to increase our cash there. So here's your adjustments to net income to get to cash flow from operations, which is 1978. Now moving on to the investing section. We're dealing with the sales and purchases of long-term assets. We come to the income statement. We go down here to the explanation. It says sold depreciate property that originally cost $46 for $10 in cash. Well, the easy part there is that we received cash of 10, so that's a positive. Now we're going to need to do a little calculation to see how much we purchased. So looking at the income statement example, sold depreciate property that originally cost 46. So on our T account, we're going to credit property, plant, and equipment by 46 because of the sale. We're going to debit, and that's the thing we need to calculate, is how much we bought. We're also going to credit the property, plant, and equipment net for the amount of depreciation, which we already calculated, 86. So our T account is going to have two credits. It's going to start with 87.45. It's going to go down to 85.15. So this is our beginning balance. This is our ending balance on your T account. And you have two credits, the sale and the depreciation. You need to figure out what debit will make that T account work. And that is 682. That debit to property, plant, equipment is a credit to cash or a reduction in cash. That's not what we paid. All right. Going back to the income statement about investments. Investments that were sold originally cost $80. They were sold at a gain of $2. So we must have sold them for $82 in or $82 million, whatever, in cash. So that is the cash we received from that sale. Okay. Going on to Treasury Stock, we took the difference between cash paid for Treasury Stock, sale of stock. When we sell new stock, we credit common stock and paid in capital. You can see that only paid in capital went up because of the amount of par value is so low that this is a rounding issue. So sale of stock is the difference between paid and capital. So at this point, we've dealt with all the current liabilities except for current portion. We've dealt with this deferred income taxes, and again, you want to keep track of it. We've dealt with investments changing, property, equipment changing, and all current assets. Okay. Moving on to our long-term liabilities, we're looking at our capital lease and financing. We know that we paid off the 139 because that was what was due in the next year. So assuming that we make all the payments due, which would be the logical assumption, that's been paid off. So that is payments, negative. And then we need to figure out, we look at the current portion and the capital lease and financing obligations together. Okay? So if we add those together and compare it to those two together, and then we take out the 139, we know we made payments. The difference is 39. That's how much more we borrowed in order for that to only go down by 100 instead of by the whole 139. Dividends is, again, we look at the difference in retained earnings and compare it to our original net income. If it didn't go up by the amount of the net income, then the amount that it differs is dividends. And then we have last account to check off, other long-term liabilities. So we have dealt with each account, okay, not the totals, but each account on the balance sheet, long-term debt, capital leases, okay. No, we did skip that. Look, the change is only one, so I put that in with the additional borrowing. That's right. Okay, so that's not a big difference. And that gives us our financing section. So we check ourselves, and yes, our operating, financing, and investing and financing add up to 436, which was what we decided at the beginning is the change in cash. This is what it should look like when it's done up nice for reporting purposes. You start with net income, you have your adjustments to get to cash flow. We usually do it in this order: non-cash expenses, then gains and losses. I lumped them together because they were kind of small, but you could separate them if you want. And then the different changes in operating assets and liabilities. See our totals as we've had on the other sheet. So this is kind of your worksheet, if you will, to get what you need. And this is what the final result should look like. Not forgetting the bottom where we have the change in cash, 436, started with 971, ended with 1407. Disclosures: cash paid for taxes, 502. That's the provision for taxes or the income tax expense, and the change in income tax payable. So we paid the tax expense plus we reduced our liability. So that's how we got that. And interest, the income statement, we start with interest expense. We go to the balance sheet, we see that interest payable went up by 11, so we didn't pay for 11 million of the expense, so we subtract it from the expense. So remember, the expense was 340. We subtract out the 11 because it went up, and so you didn't spend as much cash. And that is your disclosure. So that's what your cash flow should look like. So that should get you ready for doing one of these for homework. So Give it your best shot. Again, you'll be able to, of course, check your answers after you're done.